Chapter 1, the importance of investing. Now, investing, very simply, is not a choice. It is an absolute must-do for anybody who wishes to take their wealth and their finances seriously. A lot of people believe that investing is something for experts or only for rich people or for people that like taking risks and gambling. That isn't the case. Investing is something absolutely every single person should be doing regardless of their circumstances. And this guide will tell you why. But the primary principle behind investing is that essentially your cash loses money to inflation month in, month out. We're all aware of inflation following what happened in 2022. The cost of living crisis is what it was known as. Inflation was pretty much double-digit figures across the majority of the world. The cost of goods and services, unfortunately, increases over time. The cash and your savings that you have in the bank do not. Your cash and your savings are going backwards relative to this invisible force known as inflation. To illustrate this, what nearly all people believe is that their cash does this over time. Stays at zero. But if inflation is at 3% on average over the long term, so if inflation is here doing 3%, this is the costs of goods and services. Really, to maintain the same standard of lifestyle, this 3% may as well be the new zero. So what happens? That essentially pushes your cash to minus 3% return on investment every single year. So your cash continues to diminish and lose money. If you want to maintain exactly the same lifestyle you have 10 years from now, you need to achieve a 3% rate of return, which the bank, for the most part, does not give you. Yes, interest rates have come up slightly recently. If your bank's feeling generous, it may be giving you 2% or so, but the bank, for the most part, and cash for the most part, does not earn a 3% return on investment. You lose money every single year. The simple fact of the matter is, if we look at the Western world, if we look at 401ks in the US, if we look at workplace pensions in the UK, the government is forcing you to invest a portion of your paycheck every single month. The reason for this is the government knows it's going to have to take care of its population when they get old if they run out of money. The government's solution to this problem is to force people to contribute to a pension. Now, what do you think happens to the money in your pension scheme? Very simply, it's invested in the stock market. So if the government recognizes that investing every single month is the best solution to long-term wealth creation and securing the future finances of its population, chances are it's a very, very good solution. If you want to accumulate wealth in a meaningful manner, you need to double down on this, because your workplace pension or your 401k simply isn't going to get you there. You need to double down on this and contribute more, replicate it, especially if you're here in the Middle East or if you're in a place where there is no workplace pension. You need to be doing this all on your own back. The importance of starting early. Time is your greatest asset when it comes to accumulating wealth. Going back to our graph, right? So this is essentially inflation at zero. This is cash. Let's just say the stock market index doing a conservative 8% on the graph as well. We can very simply see that inflation over 1 year is almost negligible, and investing over 1 year is almost negligible. If you're going to generate an 8% return on investment, you may as well not bother wasting your time if you're only going to do it for 1 year. It'll make no difference whatsoever unless we're talking about investing millions, in which case it starts to become a pretty meaningful amount. But I'm going to assume the majority of you don't have millions. You've got a couple of $1,000 left over every month. If you invest $2,000 at 8% for 1 year, you're better off just not buying that meal deal. The result will be the exact same at the end of the year. But we can very clearly see, as time goes on, the difference becomes significantly more noticeable. It's negligible over a 1 year period. Over a 50-year period, it is life-changing. Inflation as well is life-changing, which is why if you're saving for 1 year, sure, go ahead, keep your cash in the bank, it doesn't matter. If you're saving throughout your entire life and you are not converting your cash into these assets which are outpacing inflation, it again is life-changing. Your cash will lose significant amounts of value. The key principle to take away from this is that time is either your biggest asset if you're investing or your biggest liability if you're sitting on cash. This is what's known as the time value of money. The value of money does not stay consistent over time. The value of money either diminishes or it increases. It just depends what you do with that value. And all money is a store of value. This is why I cannot stress enough the importance of starting early. In addition, doing as much as you can as early as you can. Because for every year you delay your investment, you're delaying another year of massive compound growth down the line. Every year you miss here costs you hundreds of thousands of dollars in 40 or 50 years. So start today, do as much as you can today. Imagine if you didn't start at zero. Imagine if you invested 100,000 today and then continued on this trajectory. You would be fast forwarding to here. You'd be saving yourself 10 years worth of investment. And then you'd be going, what does that look like on a chart? It's probably up there. That's the difference. Start as early as you can. Do as much as you can. Give yourself this head start. And I promise you, if you do this for a short enough period of time, you won't even need to think about investing and sacrificing your standard of living down the line, because compounding will do all of the hard work for you. That's the end of chapter 1. The key takeaways: money does not stay a consistent value over time. And time is your biggest asset to accumulating wealth. Take advantage of the time that you have. Make it work for you. Do not let inflation reduce your hard-earned money. Do not let the cost of goods and services outrun the pace at which your money is growing. Convert your cash into appreciating assets that are doing at least that 3% inflation, preferably 10%. We will come on to whether you should be investing in 3% or 10% return assets in further chapters, but hopefully that illustrates the point. Investing is not a choice. The government forces you to do it in most countries. If you're in a country where the government doesn't force you to do it, you need to ensure, as a bare minimum, you are at least replicating what would be a workplace pension elsewhere. But if you want to take your wealth seriously, a pension is never going to get you there. You need to do above and beyond.